Good afternoon, everyone. Welcome to the session. Am I clearly audible to all of you? Just raise the virtual hand. Okay. You all know that from where you need to type your questions. There is a webinar chat box. You all will type questions over there and I'll read. Okay, Kartike. For others also, if I'm not audible, just write in chat box. For how many I'm clearly audible? Audible, okay. Please raise hand. I can just check. If it is with one or two students, so they need to check their device. Okay, audible for most of you. So for whom I'm not audible, good evening everyone. Audible. Who said not audible? Kartike, please check your device. Maybe others are confirming that I'm clearly audible. Okay, fine. So let me give you a brief. Yesterday we have discussed basics of finance. Few subtopics I had discussed, but there was some issue. Some of you were not able to join. So the recording will also be available with you. What I'm going to do, I'm going to discuss few subtopics in a brief manner, whatever we have discussed. So initial half an hour, I'll discuss whatever we have covered in last session, right? Yes, sir. Whosoever is raising hand, if you have any query, you can write in chat box. I will respond. As I finish one PPT, I'll just check your questions. If it is related to topic, I'll immediately respond to that. Else, I'll take at the end of the session. Right? So how many of you have attended previous session? Just raise the virtual hand. Okay, most of you have attended. How many of you are attending for the first time? Now, please lower your hand, whosoever has attended. First time attendees, please raise. Okay. So Anuja and 4 others, first time attendee. Now, I'll just give you a brief, what we have covered yesterday, initial half, and then we'll proceed accordingly. In the meantime, what you can do, today the recording will be uploaded. I check with the team that in your LMS, the recording will be available today. Because mistakenly we have yesterday, what we have done, we have joined through 3rd of March link. Rather than 2nd of March link, most of you have joined the 3rd March of link, which was initiated, right? So the recording will be generated today and it will be available. It is there, Manish, you have checked it? Okay, fine. So he's confirming the recording is available over there. You all can go through the recording, and if there is any question, you can raise in next session or through ticket also. Quick brief about what we are going to cover in next 2 months. It's a plan, short-term plan. We will discuss 2 months plan and then next 2 months. So first 2 months, what are the subtopics which we are going to cover? Basics of finance, which we are discussing today. Economics, here we will discuss about features, macroeconomic features, and other related aspects which are important in terms of research or in terms of total understanding about how it is related to finance. Third, we will discuss about fixed income securities. We will discuss about asset management and mutual funds. MF is the short form which I have written, and derivative. These 5 modules will be discussed in initial 2 months, and then we will give you another plan, means what next 5 modules will be covered in next 2 months. So this way we'll keep on showing you roadmap how we are going to proceed. Next thing is, let's say we cover this basics of finance module in 3 days. So thereafter, a test will be assigned in your LMS. That MCQ will be having 50 questions, 50 multiple choice questions will be there. Answers will be available. Out of those options, you need to check it. That team will connect with you. They will send you the mails. They will inform you when the test is scheduled and how you are going to proceed with that, right? This is for all the modules. Once this is done, practice test, this will be done, another test, all MCQ. Thereafter, if there is a theoretical, then also it will be confirmed to you. Any doubt, any question pertaining to this, what we have discussed? Okay, others who have joined for the first time, again, I will give my introduction, brief introduction about myself. My name is Shilpi Srivastava. I'm a CFP, Certified Financial Planner, and MBA professional. I have over 11 years of work experience, out of which 3 years in investment banking training. Prior to that, I had worked in ICICI Bank, Kotak Security, Motilal in different profile. For others, just confirm me. Am I clearly audible to all of you? Or voice disturbance is there? Okay. Clearly audible for all of you. Akash, please check your device. Okay, fine. Fine. Thank you everyone for confirmation. We'll proceed. No, Ankit, we'll not be discussing entire thing which is for the yesterday's class, but yes, a quick recap because some of you were not able to join yesterday's link. So for them, it's a quick recap that won't be, see, usually what happens in next session, we take 5 to 10 minutes quick recap so that you can easily connect with the session and we can proceed further. So that will remain for every session, but today this recap is a little longer because I'm going to quickly brief up what we have discussed in last session, right? Hope everything is fine. All with me? Sure. Fine, Priyansh will do so. Just take some time. I'll suggest whatever links and books or something study material I'll suggest. I'll prefer sharing with all of you certain links rather than buying certain books. You can connect through some PDF which are available, which will be shared through LMS. Apart from that, just will refer to certain sites. I'll share the link as we proceed, that which site you should refer for detailed understanding about the topic and understanding about all the different areas, different aspects. Okay. Rohan, PDF will be shared. PDF will be shared, that will be in the form of just a kind of book, not the very detailed information, but yes, the entire information which is shared during the session will be covered into that. There will be certain points which I am discussing spontaneously. That means that if someone asks certain question, type certain question in the chat box and I am responding that. If you want to write down that, you can do so. That is basically, Girish, for each module, there will be one test and other things the team will update you as we proceed, right? Fine. So quickly giving you a brief from where we started, the agenda for this basic of finance module. What are the different points, area which we are going to cover here? What is finance? Understanding the concept, broad categories, 3 important decisions, and what is the objective of financial management, different techniques by which we are evaluating a business. For example, net present value, IRR, these are calculated in Excel. So prior to discussion related to Excel or calculating these NPV and IRR in Excel, I'll give a brief of Excel basic understanding so that newcomers who have yet not used Excel, they should also feel comfortable and they should also start in a same pace. So first a brief and then we'll start discussing. So that is before time value of money session. Most probably once we finish the theory part, we'll start practicing certain question in time value of money. That will be done in Excel. Okay, so this is the agenda or the point of discussion for this entire session, entire module. So Kuntal, as I had discussed, whatever contents are available in the slide will be in the form of PDF that will be available to all of you and that will be uploaded once we complete this module. Whosoever has raised hand, if there is no question, please unraise your hand, lower your hand. Okay. Fine. So that was the point or the agenda which we are going to cover. What is finance? Basically, what we have discussed yesterday, basic idea about what you understand by finance. What are the different parameters? What exactly is covered into the finance? So it's a broad aspect. In this broad aspect, what are the different activities which are included? For example, investing, borrowing, lending, budgeting, saving, forecasting. These are subset or the few areas or activities which are included in finance. Management of money is one statement or the key statement for understanding finance, right? So we can also say that study and system of money, investments, and other financial instrument. These all terms will be more clarified once you go through different category. We are going to discuss about different categories from the personal level, from public level, corporate level. So these all terms are included into that. The more we go forward, the more you will understand. Right? I think basic of finance is clear to everyone what exactly this term means. Right? So the strategy of discussion will be the moment we cover the PPT, I'll keep on asking the questions. Is there any doubt or something, you will write in chat box. Immediately we'll resolve so that there should not be bundle of questions at the end of session. Right? So immediately discussing. So that is why we are starting from the very basic so that you should all feel connect with the topic. And the platform is included of different student, variety of students are there. Someone is fresher, someone is experienced. So I'll request experienced ones to bear with everyone because you might be aware about certain concept, but for others also it is necessary to understand, right? So finance, three broad categories, what we have discussed. We can classify it or we can divide it into three different categories. One is the corporate finance, second is public, and third is personal finance. As the term corporate finance, that means we are talking about the perspective of companies, corporates. In case of public finance, we are talking about that sector, that category which dealt with the government, that is about the tax perspective, management of finance from the public, entire public. Personal finance is something which is related to ourselves as an individual. We are talking about personal finance management. You might have heard about the financial planning aspect. So let's say you want to invest X amount. So for you, there will be a certified financial planner, or you are taking advice from someone who is expert in this. That means he'll be making your portfolio, he'll be designing based on your choice, based on your risk appetite, financial goals. He'll be designing your portfolio. Overall need, I'm talking about not only the investment. This field is very broad. It is not concerned only the budgeting, insurance. It has certain other features also. In one slide, I'll give some of about the personal finance. In our session, we are not going to put more emphasis on personal finance, but yes, within a short span of time, I would like to give you a framework or the entire brief what is covered in the personal finance. And then we'll move on to the different sector. And then what are the three different financial decisions and all. That will be core area that they will discuss in detail. And TVM concept also will discuss in detail. Right? So here, any doubt, anything which is not clear to anybody? So here, policy, instrument, tax system, government expenditure, these all are the core area of public finance. Now moving to personal financial planning. This is what I was talking about. We'll take only 5 to 10 minutes to cover this, and then we'll move further. So here, there you can see different segments of personal financial planning. So we'll begin with one. Let's say educational planning. Any of the client is seeking for the child education. Now they know about the target, they know about the amount, what is required in terms of today's. If education costs 1 crore rupees, higher education I'm talking about, as on today, and the child age is 10 years. So he'll be requiring, let's say after 8 years. So how much money he'll be requiring, how much corpus he'll be requiring after 8 years, including and after adjusting the inflation on education. So that means this These all calculation, these all planning is done in this personal financial planning aspect. So educational planning, how much corpus required for education, based on that, they invest in different instruments. Cash flow planning is about entire cash inflows and outflows when it will be received. For example, they have invested certain amount in securities or different asset classes. Different asset classes means equities, debt, gold, real estate, and so on. These are different asset classes. Now what? They will be having certain tenure of investment. For example, bond, it will be having a tenure of investment, let's say 10 years. So when the cash outflow will be received, that will be cash inflow will be after 10 years. Outflow is what I am paying in terms of EMI, in terms of any installment, in terms of SIP, that is outflow. Inflow will be when I'm receiving once it is due. After 10 years, if my bond is mature, that is inflow for me. So this all cash inflow and outflow planning is there. Based on that, they will check the financial decision or goal will be fulfilled or not. How much is this? They are having less amount, how much is surplus, and based on that, they decide the future financial planning, whether it is in terms of retirement, whether it is in terms of any business setup, financial freedom, and other aspect as well. The risk management includes the areas which are related to health insurance, life insurance, assisted living, and other aspects which are related to insurance, which are related to security. Okay, financial security as well as health perspective, life. Okay, I request everyone to be with the topic only. Some questions which are not related to topic, you can connect with the concerned person with for those questions, whether you're counselor or the technical team member or the placement team, right? So for me, please ask the questions which are related to module and any other query which is related to codes. Other questions, they will be able to answer you in perfect manner because it's their department. Right. So let's come back and discuss about this. I was talking about risk management. This is clear. Educational planning. What is estate planning? Estate planning is about the succession planning. Any person who has accumulated asset in terms of, it could be real estate, it could be investment, it could be cash, everything, net worth, total amount which is available at that point of time is his net worth. That might also include debt also. So after deducting the debt, whatever amount is available, whatever total assets are available, to whom that person wants to give, or that we planning, what we call as succession planning. It might be that if they are having 4 offspring, to whom they want to give and how much they want to give, 20%, 10%. If they are preparing a will, that is different aspect. If they die without making a will, that is interviews or interstate succession and testamentary succession. These are the areas which are covered in estate planning, which we are not going to discuss over here. Will and all. I'm giving you a brief overview what is covered in which broad category area. Tax planning, you know about the old tax regime, new tax regime. So here in this tax planning, it is suggested to the investors whether old regime is suitable or favorable for them or new tax regime based on the calculation. Tax optimization techniques are suggested based on, like, for example, ELSS, how much they need to invest in ELSS, then 1010D, and if they are having agricultural income, if they are having income from other sources, rental income, how they are going to optimize tax. Here the term, yesterday also I have discussed, we are talking about optimization, not about the evasion part. So optimization means optimum utilization of the investment to take advantage of the schemes which are available for tax exemption and deductions. Right. Now, retirement planning, this all is included with the financial goal, the goal of an individual. So retirement planning means how much corpus will be required at the time of retirement. If the person wants to take retirement at age 60 or 55, then based on today's expenditure, how much it will be required at that point of time. Let's say Today, someone is investing nearly 80,000 rupees per month. So taking inflation into consideration after 20 years, how much amount he'll be requiring. So this way, and based on the life expectancy, the retirement corpus is calculated. Then they plan to achieve that corpus. This is what is personal financial planning all about. I hope I have covered it in very concise manner and given you the detail. Investment planning is included into that. It includes investment in different asset classes, means diversifying your investment, not putting all the investment in one particular category because of the risk and return profile as well. Okay, so equity, debt, real estate investment, gold, and different asset classes are there so as to maximize the return and taking care of the risk as well. Yes, Arjun, insurance is part of risk management. So insurance is not about only life insurance or term insurance. It has different aspect like health insurance. So health insurance, top up, super top up, these all are here included here, and it is guided by the personal financial planner. See, Akash, financial planning is different. Financial planning, if we are talking about personal financial planning. So here it is investment management. It is part of investment management. It comes in the broad purview of investment management, right? Not investment banking. Fine. I hope this is clear. What is difference between asset and equity? See, I give you a brief about that so that you should not get confused. What is asset? I will take different example to make you clear about this. And since you asked in perspective of the diversification and what were discussing in the term of personal financial planning. So I'll first take that example so that you can understand. So asset is different. We are talking about different asset classes. First, equity is one of the asset class, right, Gaurish? So equity is one asset class. Equity, we are talking about investment in shares. As an individual, I have different options to invest. What are the different asset classes I have? Equity means I can directly invest in share, or debt means I can invest in bond, long-term, short-term duration, ultra short-term duration bond. Can invest in fixed deposit. I can invest in gold. So equity, debt instrument, gold. Gold have different category where exchange traded funds and gold is available. Sovereign gold bond means SGB is available. I'm not putting MF in a separate asset class category because MF is inclusive of both, whether it is equity mutual fund or debt mutual fund. So broad category I have mentioned over here. Gold, similarly for gold, it could be ETF, like gold exchange traded fund or sovereign gold bond. So anyhow, gold is there. In terms of commodity investment, gold is there, right? Then you can talk about real estate. So property, it is another form like REIT, real estate investment trust. You might have heard about it, a REIT instrument. So that is kind of mutual fund, just like a mutual fund investment only, but they invest in properties, like properties which are generating rent. So thereby the investors are getting a return out of it. They are not investing the huge amount as they require for investing in real estate, but here they can invest less amount and take exposure in real estate. So these are asset classes. Equity is one of that. That means I'm investing into share. This is one example. Now, second, taking asset into a different category. What is asset? What is liability? I, as an investor, is having certain assets and liabilities. If I have a car, house, investments, gold. So these are, what are these? These are my assets. And what are my liabilities? If I have taken any loan, whether it is home loan, personal loan, any debt is my liability, which is due and I need to pay that. So that is the concept of asset and liability. What I owe, what I own. What I own is asset, what I owe is my responsibility. Okay, so asset is that. So different, I hope it is clear now. Who asked this question? Gaurish. Okay. Rahul, for that, you need to go through some reference because yesterday also I clear someone asked about the crypto. So I said that frankly, I don't have that much learning experience or I have not gone through it in detail. So I stay away from this topic. Right. But yes, I can suggest certain link. I'll just go through and maybe just give me some time so that I can tell you where to refer. Right. H1, etc. will cover. No issue. We'll describe in brief what exactly is being done in hedge funds and all, but not crypto. Okay. So I hope the question is clear. Now, talking about the public finance. This is the broad area, what we refer like managing a country's revenue. As an individual, what we are doing, we are managing our own finances. That comes in our personal. Here, public means country's revenue. We are talking about the nation's perspective. So, country's revenue, debt, expenditure, different institutions, different non-governmental institution, or where there is not only that is not purely government. Quasi means mixed, which is not purely government institution, but yes, government are having their control over those organization or the institutions. So these are managed by this. How do they collect revenue? What is the source of revenue? Through the taxes. Like we as an individual avail certain services. So on those services, what we do, what we provide, this is the tax we give. That is revenue for the government. And this revenue is utilized for the benefit of nation. So that amount is utilized. Now, these all aspects are included in terms of public finance, which is the area or the domain of the government of that particular country. So what is the purpose behind it? Objective behind this public finance? Meeting personal requirement. So, public requirement. Once the revenue is collected, as I have just discussed about the revenue collection via taxes. So now that will be implied or that will be utilized for the purpose of meeting public requirement. Next is for what? For economic growth and development. What could be these areas? Like you know about the hospital, you know about different facilities which are provided, which we all are utilizing. Maybe may it be infrastructure, may it be the health sector. So these all are part of the economic growth and development, which reduces inequality. Means this is available for all mass, like road is there or any infrastructure is there. So it's not like only one category can avail that road facility, others will not. It is for everyone. So equality is there. Whatever is collected through public finance is utilized for the purpose of entire public of that particular country. So price stability is also maintained out of this. You might have heard about the stabilization or different, what to say, that products available for or services available, which are provided at the subsidized rate. So that is what price stability is maintained. So each and everyone should afford that, can be affordable for that. Okay, I can see further question. See, Rohan, you have asked a question which is related to fixed income security part. So I'll just read the question. So while answering, others should also know what is the question. So he's writing that what is fixed and variable income bearing security? Fixed income security, that means you can take an example of bond. For example, I invested in a bond which is having a tenure of 10 years. For 10 years, that company which has issued the bond has promised to pay a fixed amount of coupon, like 9%, 10%. So for complete 10 years, every year, or if it is annual, semi-annual, what is the frequency of that coupon? If it is annual, I'm assuming that annual frequency is there. I'll be getting 10% of face value on every year. That is my coupon payment. It is fixed. There will be no variation. Variable income bearing security will not provide fixed rate of coupon. Okay. That could be step up or a step down bond. A step up means initially they will pay less, gradually they will pay high. A step down, gradually they will go down. So up means they are going to increase. This is like this only. Although I'll explain it into fixed income securities, but since you asked, step up a bond, initially they will provide low and gradually they'll increase. Step down, initially high and gradually it will go down. So this is about variable interest rate, not fixed. One example is for your question. Okay. I hope your doubt is clear now, Rohan. Okay, let's move ahead. We are going to discuss corporate finance now. So basically, if we talk about the corporate finance, first point is from which perspective we are talking about. We are taking the corporate into consideration while discussing. In public, what we have done, the government was there. The personal, that means we were talking about individual perspective. Here we are talking about the perspective of institutions or corporates. So institutions are requiring money for what purpose? For different purposes, maybe for expansion plan, for meeting of their working capital requirement, and other options are also there. So that means funding operation. Funding is their need to operate. Working capital for less term. That means short-term requirement. For long-term requirement, more than 1 year period. For that, they have different option. They raise funds. How they raise funds? They have two options available. One is the equity financing and next is debt financing. What is the main motive or objective of those corporates? Objective is always maximizing profit and minimizing the cost. Once the cost is minimized, profit margin will increase. So the both will go hand on hand. Once they minimize cost, their profit margin will maximize, will go up. And other factors are also important along with that. How the business obtain financing? I have just discussed about the two major options available with them, ECM and DCM, equity capital market or debt capital market, or equity financing or debt financing. What is covered in equity financing? Anybody who can give the answer about the equity financing? Just you can write the answer in chat box. This is two options available for a corporate to raise funds. 1 second, let me read the answers. Most of you have written in the chat box. Through shares, yes, equity is through shares, like IPO, yes, Rahul, fine. Giving shares of the company, showing the shares, equity, like shareholders, raising fund. These all are the points which you are writing. I'm reading fast. IPO. So equity here, we are talking about initial public offer. They are issuing shares. Buying the ownership of company, right? Surrendering part of capital company to raise capital. Yes, Priyansh. So surrendering part of company, that means if I summarize your term and give another term, that will be exit strategy. I'll explain here what exit strategy means. Exit is private placement is I'll explain more of private placement also. Let be there with this part only. Then we'll discuss your part also. So let's say this is the entire circle. Now what? Nearly 20%, 25%? Yes, 20%. So let's say they want to, this much is number of shares, this much percentage is offered via initial public offer. So that means they are exiting from this 20%. Rest will be owned by them. This is exit strategy. They are issuing shares to the public. Now this 20% will be held by the shareholders, like investors will become shareholders of this percentage. So this is exit strategy or IPO, the number of shares they have issued. So ownership stake is there with investors. That is different. Royalty is different. Private placement is, Gaurav, private placement is something which is related to not offering to the public. Here we are talking about IPO. That means we are talking about something which is open to public. You and I can invest into that. In private placement, the set of customers are different. The set of customers are known to that investors. That means, let's say ABC company wants to raise money. They have different option. Private placement is one of them. They can connect through their own family members, set of friends, relative, institution investor. Means the limited investors will be there. That is not open for public. They will raise money via this set of customers or the investors which are known to them. Usually they are very close to them, family, friends, or one or two institutional clients are there. So this is private placement. It is not open for public. Here IPO we are talking about, which is open for general public. For example, this CRISIL, DOMS, LIC, NICA, these all IPO which has come in recent 1 or 2 years, you can consider that into category of public. Any company wants to go public, that means it is open for everyone, retail customers also. Although there are certain quota. Quota means reservation for different categories. For QIB, that is qualified institutional bidder. For retail investors. For non-institutional investors. So there are different category and percentage is fixed. Reservation is reserved for each category. That I'll explain once we discuss about initial public offer. For till now, you just understand about these concepts. So debt here, as the equity IPO comes, debt IPO is also there. But that is in the form of bonds. They issue bond. Here, they are selling ownership. That means, let's say ABC company has come up with IPO. So I have applied for that IPO. Now, the number of shares I receive after allotment, I'll be owner of that. I'll be receiving the communication from the company for voting rights. Like ownership comes with voting right, but in terms of debt, it doesn't. It is not there. Ownership is not there. That is a kind of loan. In case of debt, it is like a loan. If it is a 5-year bond, so I have paid certain amount to the company, and company will use that amount for 5 years. During these 5 years, company has promised me certain amount, just like fixed interest rate. They have promised me to pay 9% or 8%. They will keep on paying me on annual basis or semi-annual basis. That is totally the discretion of that bond, which is given initially. Here, they will pay the face value. Right. So these are two options available with the company. Here they are selling their ownership stake. Here they need not sell the ownership stake, and it is less costly. That is always cheaper, and they know the future cash outflow when it is due. For equities, it is totally once the company is performing well, what they do, they are declaring the dividend. They are sharing their profit as a part of dividend. They might provide dividend. They might not. They might keep it as a retained earning. Retention ratio is there, means either they will provide the payout or not. It's totally depends on company discretion. But in case of debt, if they have promised to pay certain amount initially, they need to abide by that promise. Okay, so this is the basic difference between equity and debt. Exit strategy, Tanisha, I have just explained. Exit strategy means this is the company. Now what? Earlier, what was the ownership stake? Company has entire 100% of shares. Once it comes to IPO, what they are doing? They are selling some portion of their equity to the public, making it available for normal public. So public will also become owner of that company. That means, let's say, Reliance Industry. I am owning certain shares in Reliance Industry. So I am owner of that much fraction of number of shares. Total number of shares outstanding, let's say the market capitalization is 17 lakh crore or 20 lakh crore. So out of that, what is number of shares outstanding? How much is my portion? So 0.0000, what is my ownership in that? That is very fractional. So this way, I'm also having how much they can hold. As you invest more, or you will have more ownership, right? So you might have seen the own ballot or the communication which is provided by the company, voting rights, any important decision of the company, they used to inform through mailers, through postal ballots, and the investors will come to know they have the voting rights as well. to participate in the major decisions of that company. Okay. Exit strategy, I hope is clear. So this much is they have exited. Now they are only this much portion is held by them, and the shaded portion, out from the shaded portion they had exit. So the term is used as exit strategy. One more term for IPO. Can dividend on equity share? See, Rohan, this is the part of taxation. Earlier, what happened? Dividend was tax-free in the hand of investor. Now the rules has been changed. So that is included in the income. Other income from other sources, it will be added into the income only based on tax, based on the slab of investor, it will be taxed. So it's not tax-free now. Earlier, it used to be tax-free in the hand of an investor. Not now. Yes, Gorish. Shares and stock are the similar terms which are used interchangeably. If I'm using, I have invested in stock. So that means I'm talking about that company, SBI stock, SBI shares. Similar terms are there. Okay, so here till now it is clear to everyone. Like we were talking about the different financing, different means by which they can finance. One option is also there. Although we have discussed broadly about the equity and debt portion, one part is there. The company can go for the bank loan as well, but they need to look that how much amount they need to pay. What is the interest amount? Is it better option or raising money via bond is better option? If they go for bank, let's say I, being an investor, approaches bank, and how much a bank is charging? Bank is giving me at 14%. But bond, as to the bond investors, how much I need to pay as a coupon amount? Bond investors are getting 8%. That means that is a cheaper way. That is less costly for the corporate to raise money via issuance of bond rather than going for bank loan. And for bank loan, not going for bank loan, there are different ways or reasons. What is the one reason? One is the loan should be sizable. Bank has certain compliance aspect, regulatory aspect. They need to check the entire financial health of the company, their past record. If they find everything is well, then only it is approved. Otherwise, the situation will be just like Yes Bank, providing the loan to the companies which are not financially well, which are financially struggling. And once the NPA of the bank increases, credit event occurs, which has you might have heard about the case study, you might have read the case study of Yes Bank or Lakshmi Vilas Bank. So how these bank has faced the moratorium period and the situation of bankruptcy because of these NPA, which has been increased due to non-payment of the loan which they have given to different corporates like ADAG and DHFL, etc., which defaulted, and that lead to downfall of Yes Bank. One second, let me read the point. Akash, which line? Bond interest line. This one. I'll explain it. This is like, let's say, I'll give you an example. For example, this is face value of the bond or the par value of the bond. So I, as an investor, has invested face value multiplied by the number of units which I have applied. Here, if they promise to pay, let's say, 10% coupon. So every year, what I'm getting? 10 rupees as a coupon amount. 40 rupees as a coupon for 4 years, and last one 110 means this 100 face value plus 10 rupees coupon. So that means I know what is my inflow as an investor. Similarly, that company also knows what are the future obligation, cash outflow for the company. This is the coupon amount which you are asking, bond interest line, right? This we have taken a hypothetical example of 10% or 5-year bond. It will be varying based on the bond tenure, based on the coupon and face value, right? RBI can change the interest whenever in bank loan. Yes, Teja, that is definitely there. It keeps on revising, they keep on changing the loan. It might have been. So there are different category also, fixed or floating, what we have opted. If it is fixed, that will remain same irrespective of the interest rate in the economy. If interest rate in economy has gone down, Then too, if I have chosen a fixed rate of interest, I need to pay that. If I have opted for floating, that will be changed. Okay. Bonds are also evaluated by credit rating companies. Yes, Gaurav, bank, the credit rating is given by certain credit rating agency. For example, CRISIL, ICRA, Moody, S&P 500. These are the global S&P 500 and all, and other agencies as well. So what they are doing, they are checking the financial health of company, and thereby they are providing certain grading. So grading might range from A to D, triple A plus, BB plus, C, and then D. D is the default category. Default category means there is risky instrument. Junk bonds are falling in the D category, right? So that means as an investor, I need to check the rating as well. If it is AAA, that means that is better or safe to invest as compared to other bonds. Okay. See, Akash, there are different perspectives. Bank, as an investor, if your question is you are asking from the perspective of investor, that depends on various factors. There is no generalized suggestion for everyone. For me, bank FD might be suitable. For others, bond might be suitable. That depends on different factors. When I need money, how much risk appetite I'm having, my goals, my inflows, right? My total income, how much I need to invest, what is my saving, what is my surplus, cash outflow, inflow, various factors are there. So giving a concise options like based on the interest. In bank, what happens? FD is giving nearly 7.1 to 7.25%, 20 basis point here and there. I'm taking 7.1%. This is the interest rate in FD. What is going to happen? You are going to calculate yield. Yield means post-tax. Let's say if you have taken a second huge amount of FD and that is added in your income. How much is tax free? Up to 1 lakh only. TDS will not be deducted. Thereafter, TDS will be deducted. Plus, that will be added in your annual income. Adding that amount, FD interest in your annual income will increase your tax slab. You need to pay higher amount. So effective yield will be less. You won't be getting 7.1% in hand if you are working and other income is also there. Now, talking about bond. So in case of bond, what happened? Effective yield is there, 8%. Bond taxations are different as compared to FD. So maybe you might be getting a little more in bond as compared to fixed deposit. But that totally depends on investors category. If someone who is not working, only the income source is through FD and less amount is there, then equity, then fixed deposit is okay for them. So that is a complete different status based on different individual and category, and then only it can be advised that which one is suitable for them. Okay, now taking another question. Or in a generalized way, Akash, there should be a judicious mix of all instruments. It's not only the entire, you might have heard about, don't put all your eggs in the same basket. So there should be mix of each and every asset class so that if one asset class is facing any issue, let's say about the COVID scenario, what has happened? It was a systematic risk which has impacted the entire market. So to avoid that risk, to minimize that risk, we need to invest in different asset classes. Is equity source of finance is always better than debt? It is not a general, we cannot generalize this, Krishna. There are so many factors. We are talking about the corporate. So equity source of finance, if nobody wants to dilute their equity stake, they don't want to sell their equity. It is very close to them. If you have a company, you will prefer raising money via different sources, via debt, via different, let's say, bank loans or raising bond where you know about the obligation after 10 years you will repay and the entire company. So as less as they want to share as less as they can. But there are different factors as well where the short term, if they have short term goal where they have acquired a business for the perspective of uh, making it more profitable or for further selling. Usually there are certain companies or there are certain startup investors, what they do, they acquire certain business and make it profitable, and after, say, they have very short-term vision, after 3 to 5 years, they will again sell it. So that depends on how this take the things, how is their perspective. Yes, Rahul, the economy, see what happens, we are talking about different asset classes. Generally, we have seen that gold is inversely proportionate to the market return. Once market is very going up, usually market is going down, gold goes up. So usually they take investment in gold. Other asset classes there. But there are certain exceptions to this rule also. We might find certain times where it is not behaving in that based on that thumb rule. So this is about asset class, Rahul, what you have mentioned. So differently, we are investing in different asset classes. So if one is at risk, another is giving return. So overall portfolio is not impacted that much. Had I invested entire amount or 100% in equity and equity market crashed, so my amount will be suffering. If I have invested 30%, 20%, 20, all based on a different allocation, which is decided after analyzing different factors, then my entire portfolio will not suffer. Yes, there are bond taxation is different. That is applicable. LTCG, STCG, that we will cover later, that in terms of fixed income securities, Manish. Okay. What will be the difference between purchasing a bond and providing a loan to the company with same rate of interest? Usually, it does not happen, Rohan. Like, we can take one example. Both, there could be certain situation, but this is basically the discretion of investor, what they choose. They want to go for bank loan or they want to go for bond. If I am, as say, there are two parties involved. If your question is from the perspective of investor, whether I select investment in bond or investment in fixed deposit, both are giving me 8%. So maybe I will choose, if my tenure is short term, like 1 year, I will choose FD because after 1 year it will be liquidated. If my tenure is long and I feel that the interest rate will go down, I will book it at 8% now and I'll keep on getting the 8% only, right? So analyzing different factors, this decision will be made. This is the example from the perspective of me as an investor. Now talking about corporate perspective. If they're getting loan from the bank, 8%. Next, another thing is if they are raising money via issuance of bond, they need to provide 8% as a coupon amount. If it is fixed, next, what happens? You know the relationship of interest rate and bond prices. If interest rate in the economy increases, bond price will go down. So next year, the same bond will be available at less price. So more demand of that, the bond which is available at less price. So thinking about all the scenario, they will decide which one is profitable for them. Not only one factor is impacted, other things are also taken into consideration while deciding these things. Okay, 1 second, let me check it. If I have missed any question, let me go through. Paramdeep, you are typing in different Q&A section. I'll take your question base. Ideal proportion of equity and debt. See, that depends, as I have discussed. If you are talking about the capital structure, that will be thoroughly covered in a different module, but here I'll give you brief. Debt should not be more because it has certain risk parameter as well. What if company is not profitable? What if cash outflows are not available at that point of time? Because coupon will be due. If I have raised the money, I know how much amount will be due at this point of time. If it is annual, semi-annual, I know my future obligation as a company. Am I able to meet out that? If I'm not, that could lead to credit event, means bankruptcy, failure to pay, and all. And the credit rating will be spoiled. Another point is, what was your next point? I'll just check what you have asked next. Ideal proportion of equity and debt. It should be a judicious. Sometimes it could be great as well. More than 50% is also okay, but that depends on the various factor, how easily they can meet out. They can fulfill the debt obligation. If they can meet out and they can grow, that is fine. Excess is worst, right? Excess should not be there. There should be optimum mix, That will discuss based on situations. We'll take certain example and then discuss about that. As corporate, why would I take a bank loan which is fluctuating? That is what I have discussed ages. So company will think about their perspective. They will feel how much they are earning, what is their earning potential, cash inflows and outflows, if they are able to meet out the obligation, and what is more favorable for them. If it is costly, they will not go for something which will be higher payout. They will always select some option which is available easily, less cumbersome process, and they can repay it, which is less risky. Okay, fine. Now let's discuss this maximizing the value of business through proper planning and implementing management resources while balancing risk and profitability of the company. Balancing risk simply means here we are talking about take one example of investor. Then you will understand it from the perspective of corporate as well. Now, you as an investor have certain amount to invest. Let's say 10 lakh rupees. What are different options available for you? Asset classes, you have equity, you have debt, you have gold, you have commodities. Mutual fund is a part of equity and debt only. You have real estate. There are different parameters on which you will judge. One is the liquidity, another is risk associated. If you all will be aware about the risk return rate. Equities comes with higher risk. Again, further subset of equities, index, sectoral, interest. If sector is specific, if I invest in one particular sector, I am going for more higher risk. If there is something unfavorable to that sector, my entire portfolio will go down. So here also there is subcategory available in equity. So this 10, you are not investing entirely in equity. Take one example, entire 10 lakh rupees is invested into equity. And anyhow, due to market risk, there is some systematic risk, external factor, COVID-like scenario, war situation, market goes down, market crashes. The entire amount is at risk. If it goes down by 20%, you will have left with 8 lakh rupees. Next example, what is available to you is you can invest certain portion, let's say 20-30% percentage of the investment into equity, 20% into debt, some in gold, some in real estate. All the asset classes will not crash immediately. They all will behave differently based on the different scenarios. As you know about the gold, how it behaves inversely to the market. Market is having more risk, gold price. Because as an investor, we look for another revenue. Most of the people have noticed about the COVID scenario. Market has came down. What the investors were looking for? They were waiting for the market to come up. Most of the investors have not invested the money, although it was ideal time to invest. Because from there, within 1 year, some of the equity, some of the instruments have received even 100% return. But that is the market sentiment or investor behavior. Once the herd is following exit, so they all will exit. They all will invest once they see it is rising up to certain level. So here the example is how I'm balancing my risk by not putting into one risky instrument. I am segregating it into different asset class. And then thereby my profitability is there. Similarly for the company also, how they are balancing their risk by their capital structure. By equity and debt instrument, they will not take huge debt. Once they have taken huge debt and let's say the business is not performing, what is going to happen? In COVID scenario, you have seen businesses came down. They have stopped generating the revenue because nobody was bothered to go out. They were hotel industry, restaurant, and other category as well. Only bare minimum, only FMCG or what we need on a regular basis was working. Else, the sectors which are different category, for example, whether restaurant, whether hotel industry, and these things were suffered a lot. Some of the businesses shut down. So this is the category we are talking about. How do they, if they have taken a loan, what is going to happen? They need to pay at certain time. Once it is due, they need to pay. There will be no deviation from that, right? They cannot avoid non-payment and all. They cannot delay it. Otherwise, again, there will be interest, compound interest will be there. So this balancing risk means whether it is business or individual, they need to maintain profitability and risk at certain level. Equilibrium should be maintained. That's it. Okay. Now talking about these all aspects, who are the entities or the parties involved in these transactions? So parties, in very brief, you can understand buyer and seller. If any transaction is there, there are two parties, bare minimum two parties will be there. One will be the buyer, one will be the seller, whether it is any transaction. So who are the entities? Taking broad category. Investors. So investors, we are talking about retail investor, HNI. HNI is high net worth individual. Retail, category of retail is whosoever is investing less amount at one go, less than high net worth. So category wise, retail comes below high net worth individual, ultra high net worth individual. These are investors category. Then corporates. Corporate means we are talking about two category, public and private. Corporation, private is public. Corporations also invest in a different instrument, and similarly with the private corporations. And they are issuer also. They can be investor, they can be issuer. For example, if I talk about ABC Limited, which is a corporate, private corporate, has issue, raise money via issuance of bond. That is about, I'm talking about private corporation. Now, public corporations, you know, public limited companies, which are already listed, those are also involved in raising money. They further raise. Once, one more point I would like to add here in terms of initial public offer. You know about IPO. Any company wants to go public, first time they issue shares, that is initial public offer. If they want to raise more money, what is the second round? How it will be termed as? If they again raise money, that will be termed as follow-on public offer, FPO. Right? I think some of you have mentioned in the chat box, FPO. Yes, right. So this is follow-on public offer. Right. That gives me a quick refresher or say understanding that how many of you are exactly attentively with me with the session. That's great. Thank you everyone for mentioning. Sometimes it is not required to ask, but it is quick check of availability of all of you. Fine. Next, coming to the third category, which is institutional investor. Who are institutional investor? Mutual funds, pension funds, private equity funds, like PE funds, venture capital. So briefing the private equity venture capital funds is venture capital, you can take the entities which are small, which are the startup companies, which have huge potential to grow in future. So these can be considered as a form of private equity firm as well, which is set of customer is there where the investment is not made by the public. It is not offered. They haven't offered initial public offer. They have not offered their shares in for entire public. Okay, there could be certain reservations for the company side as well for the basic requirement, because for going public, there are certain rules and regulations. IPOs means that companies profit, their net worth requirement, and other factors are also important. If they fulfill those norms, rules, and regulations, then only they get the SEBI approval and the stock exchanges approval, and then they can go for it. Fine. So till here we have covered what are the different entities involved in these transactions. Okay, fine. Now, talking about different transaction. One is initial public offer. What is initial public offer? Although we have discussed many times, anybody would like to mention it? Anybody would like to write what is initial public offer? Sankalp, I had not mentioned NPO. It was FPO, follow on public offer. Don't worry, I'll repeat that. Okay. Fine. Let me quickly read the answers which you all are writing in chat box. So, company selling a stake. Okay, Rahul. First offer on shares when a company goes first time public. Fine, Kartike. Company making public offer for the first time. This is all the answers I'm reading from the chat box. Raising money via issuing equity stocks to public. First time raising fund. Next is a company raising funds for the first time is called IPO and it is open for everyone. First time he issues the shares to public. Okay, most of you have written first time public when a company is listed in S&P 500 so that investor can buy. Jefferson, you have mentioned a point, second step. What you have mentioned is the second step. When a company is listed in S&P 500, that is index you are talking about. So prior to that, this is the secondary market aspect, means share got listed now. First is primary market. We are talking about initial public market, which is primary offer. Then second, it will become secondary once it is available for trade in stock exchange, whether it's at S&P 500. If we are talking about India, we will talk about National Stock Exchange, Bombay Stock Exchange. If the share is listed on an NSE and BSE, it will be available for trade among the investors. You and I can trade with each other through that real estate monitoring or that platform, which is called as exchange. But prior to that, we need to get allotment done once the company goes public through initial public offer. Right. So a little modification in your point, although you have written correct, but you have mentioned the second stage. I was asking for the first point. One second. So unlisted company issue shares to public, yes. Initially company comes to public and further. Did I miss any point which anybody wants to mention and I haven't read that? Private company sells shares to the public. So this is complete process IPO, although I'll be covering it in cash equity part where entire steps will be clear. But here I'll give you a brief idea about how the process goes. Any company, for example, let's say ABC company. This is a new company. It wants its shares to get listed on a stock exchange. So what are the steps involved? One, first they will hire an investment banker, who is also called lead manager, merchant banker. So now merchant banker will be responsible for each and every activity which is required for initial public offer. What they will do, they will prepare draft red herring prospect. DRHP, draft red herring prospect. So draft red herring prospect is prepared by them. It includes all the details, minute details which are required by Securities and Exchange Board of India. Securities and Exchange Board of India I have mentioned because we are talking about India. In case of US, it will be SEC, Securities and Exchange Commission. Similarly, for other countries, the regulatory body, which is responsible for managing the stock exchange or regulating the stock exchange. So this draft red herring prospect is there. Then if everything goes fine, they are eligible for each and every minute detail, they fulfill the requirements, then they get the approval from SEBI. Then once the SEBI approval is there, stock exchanges approval is required where they want their share to get listed. That is NSE and BSE. Both the stock exchange approve that. Then the second stage is about marketing, advertising, then the issue could be two types. One is book building, one is fixed price. Fixed price where they decide the price of issue in advance. That 100 rupees per share is decided. Then it could be book building, means based on demand, the cutoff price is decided. There is a range given, means 20%. If let's take one example, 900 to 980 to 1000. So that is the range given. Anybody, any investor who wish to apply, if they quote cutoff price, so any price between this range, if it opens on that, they will get the share, they'll get the allotment, right? So similarly, the difference between the fixed price and this cutoff we have discussed. Thereafter, it is listing is or what to say, allotment has been done. Means we as an investor have applied for ABC Limited, so we'll get the shares allotted in our demat account. And then after once it is listed on the stock exchange, the day it opens, it is available for buying and selling for the public. Okay, then it is now the share comes to the secondary market platform. Prior to that, it was primary market platform. See, Rohan, it is decided by the company only. Like they give a range. There are two options available, whether they are going for fixed price issue or book building. Then again, fixed price is decided by different methodology, by relative valuation, by DCF valuation, how they are going to decide the price of that particular share. Okay. Okay, how many of you require break? Because I'm getting some point. Somebody who requires break. We can take 5 minutes break. Just raise the virtual hand. How many of you? Okay, fine. Just take 5 minutes break. Everyone there? So I hope you all have come from the break. Okay, Pooja. Okay, Prachi. Yes, someone has written the question. Yes, Monica, that is good. That is always great. The added advantage will give you benefit over others, and that will give you edge over others, right, Monica? No, no, Krishna. Gray market is different town. Okay. Draft red herring prospect, Gajendra. I'll give you a link of everyone. Once we discuss the cash equity part, I'll give you the detailed version of how to just go through how what are the different credentials available in draft red herring prospect. Okay. So it includes basically what it is. It includes the prospect. It is what prospectus. What the prospectus include? How many shares will be offered to the company? What is the track record of the company? What is the business of the company? In which sector they are doing business? What are the proposition? Why they want to? So basic idea will be there as you have mentioned. So I'll just share one link to all of you. This is a SEBI PPT. You can easily download it. It is easily available for everyone. Let me just check, if I can share that with all of you through chat box. Just wait a minute. Okay, wait. Give me a minute. I'm just checking if it is available. I'll share it with all of you, the link. Everyone got one PDF, like that is a PPT version. Just raise the hand. How many of you got that? Okay, Manish, Pooja. Okay, you all are confirming. So this is from the SEBI website. You get a lot of information which is available over the net. I'll keep on sharing these kind of information with all of you. Okay, fine then. All of you have got it. You can go through it. Reshmi, it is, I have just shared it with the chat box. Wait, I'm again sharing it. Not get, no problem, no problem. I'll share the link also. Some of you got, are mentioning received, some not. No problem. Whosoever has not received, tomorrow, means next session, I'll share the link as well. Okay. In the meantime, just we'll discuss these all points, right? So here, taking one by one, IPO I have described in detail about the concise version of what IPO is. Further, we'll cover in cash equity module. What is FPO? That is follow-on public offer. I'll explain in brief what exactly follow-on public offer means. Any company, the first time is what? Primary IPO, initial public offer in primary market. Any company which is not listed, they want to go public, they want to get their share listed on the stock exchange, they first need to offer through primary market, that is initial public offer. Proper steps are there. They take approval from SEBI, how much shares, number of shares will be underwritten, number of shares listed. These all things are decided during IPO. And let's say once it is available for trade, it is listed on a stock exchange and it is available for trade between public. So you and I as an investor can trade once it is available on secondary market. What is follow-on public offer? The number of shares which there are certain issued capital authorized capital. So based on SEBI approval, they give certain approval. This much is the authorized capital, means that company can raise that much capital. If they are authorized to raise, let's say 10,000 crore. So for this 10,000 crore, if they are not raising the entire amount at one go, certain is non-issued capital. One is issued capital, one is unissued capital. So rest amount they can, in the second round, they can raise. So for initial public offer, let's say X amount was there, which was authorized, but they haven't raised at one go. Follow-on public offer, they are further raising. The second round, you can understand. So this share is already listed now. They came up with another issue. They want to raise more funds via issuance of equity. So the second option is follow-on public offer. I'll quote one example. Although it's long back, they have done that. You will find a number of companies for follow-on public offer, like NTPC. NTPC came up with IPO in year 2004-5, nearly 2004-5, when the IPO of National Thermal Power Corporation came. Thereafter, they came up with follow-on public offer in next few subsequent years. So this is the example of FPO, follow-on public offer. You will find furthermore some lot of companies who has came up with the follow-on public offer as well. The shares were already listed. So this is less cumbersome process, less time-consuming process, because everything is being done. The due diligence, compliance, pricing has already been done. Now what they need to do, they are just raising. It takes less time as compared to initial public offer. Private placement, that means, as I've already discussed, set of customers are there, set of private customers are there. Any company wants to raise money, so it will do with the set of private investors available. That could be family, friends, few investors only, not the normal public. Common public will not be involved in that private placement. M&A, merger and acquisition. LBO, leverage buyout. What is leverage buyout? It is a part of merger and acquisition only, but the difference is in this leverage buyout, one company which acquires another company takes certain debt. Sometimes the debt portion is higher than 80-90%. So one example for LBO could be Patanjali and Ruchi Soya, where Patanjali has acquired Ruchi Soya. So as far as I remember, the total deal amount was 4,500 crore. Out of that 4,500 crore, nearly 3,500 crore was by debt. So let's say any company wants to acquire another company, what they do, they don't have the entire amount available. They borrow it either via issuance of bond or loan, and then by that amount they buy another company, they acquire another company. That is leverage buyout. Restructuring. Few examples of restructuring are mentioned over here, which you can see: Dabur India Limited, Dabur Pharma Limited, demerger in 2003. That is restructuring between the company. A conglomerate are having different divisions available with the company. For example, you know about the Reliance. So restructuring means merger and demerger happened with the same company. It could be operational restructuring, it could be financial restructuring. So in 2003, these are two examples which I have mentioned over here. One is Dabur India, Dabur Pharma demerger. These companies were demerged in 2003. That was part of restructuring. Once they see one unit separately performing is in demand and it might perform well, it might gain more revenue, so they demerge it. Then Bajaj Holding Investment Limited, that is also called BHIL, into Bajaj Auto Limited. So Bajaj Holdings and Investment Limited, separate division, Bajaj Auto Limited and Bajaj Finserv Limited. Both are separated, both are different vertical. That was done in 2007. These are the certain example of restructuring. For LBO, I have quoted one example. Now let me take the question. Some of you have written the question in chat box. LBO, I have given example, Manish. Let's say I have quoted the example very well in terms of Patanjali and Ruchi Soya, where Patanjali has acquired Ruchi Soya. So they have not paid the entire amount via cash or shares. It was borne by debt. The total deal amount was 4,500 crore. That means Patanjali acquired Ruchi Soya in 4,500 crore, out of which 3,500 crore was borne by debt. It was debt. That is called leverage buyout. Okay. What is Primary and SI. Kevin, you have written something. Primary, I could understand. And what is SI? Secondary market, you want to ask? Primary and secondary market? This is your question? Yes, Bank also came up with IPO. You will find a number of companies which came up. I have quoted only one example, Yes Bank, ICICI Bank also. No, FPO is not for only for existing shareholders. Anyone is free to apply for that. Follow-on public offer is open for all, not for existing. For existing, right issue is there. Whosoever is existing shareholders, the right issue is there. Right, Krishna? Okay. Primary and secondary market, I'll explain. Kevin, you have written about it. Rajendra, I'm not sure about this group and all. For that, you can connect with the career coach team and all, because that is not my department. Study material and everything will be shared through LMS. Fine. I hope I have covered all the question. One question is left about the primary and secondary market. That is also that I'll cover. And the one more question is from Nitiksha about M&A. Right. Tanisha. Fine. Let's take one by one because otherwise it will be piled up. So one is you are talking about the primary market and secondary market. I'll explain with the simplest way to understand with example. Primary is what, let's say any company wants to go public. So we will take the previous example. For example, LIC. Although it has been 2.5 years once LIC got listed. So how it came? They have issued through primary market. So once any company comes up with initial public offer, you know it through different ways, by digital way, by communication through mail, from news, from media. You came to know about this company is going public. This company is going to launch initial public offer. That is primary market. If I apply through the previous IPO, for example, DOMS, that is stationary, and the CRISIL. So this is these IPOs, these companies came through initial public offer. That was part of primary market once they issued their share. Now what? Since it is listed, they have already opened, the issue is open and it has listed on the stock exchange. Now it is part of secondary market. So if DOMS share and CRISIL share is listed on the stock exchange, it can be traded between investors, existing investor. If anybody who got the allotment in DOMS want to sell their share, I haven't applied, I want to buy the shares, or I have applied, I want to buy more, I can buy through secondary market. So secondary platform is basically the stock market platform, exchange platform in NSE and BSE, where buyers and sellers trade through these platforms. They trade between each other, and through these NSE and BSE, which is automated trading platform, there is no mediator called issuer. There is no role of issuer in secondary market. But in case of primary market, what happens in primary market? Issuer and investor is there. It is between issuer and investor, and they are offering shares to normal public. Fine. So primary and secondary, who asked, the point is clear. Then the second example. Yes, Gaurav, these are some example for transaction. There are many more example, corporate actions and all. We will discuss it later as well, right? Restructuring, we have given two example vision. One is about these Dabur, Bajaj, Reliance Industry. So restructuring means the company restructures its financial or operation part. That means in terms of hierarchy, if they make certain changes, so anything related to hierarchy of the company, anything related to division of the company, that means there are two separate divisions. One is performing well, another is not performing. So what they want to do, they want to liquidate one division and utilize that amount in the betterment of one particular division. So that can also be one restructuring. Okay. Now what? LBO, Tanisha, I have given one example, leverage buyout. I'll quote it in a simple way. Simple way means What is acquisition? Acquisition is company A wants to acquire another company. A want to acquire B. So that simply means A need to pay some amount to B. What if the amount is 100 crore rupees, but A does not have 100 crore rupees. It has only 30 crore rupees. So rest 70 crore, it has taken a loan and up. Then it has become 100 crore. Now it will buy B. So that is leverage buyout. Or what A does, A raises 70 crore via bond, via debt. They issued bond and then based on the cash flows, then they provide the coupon rate. So majorly, once the deal is borne by debt, it is called as leverage buyout. It is kind of acquisition only. Once acquisition is borne by major amount of acquisition is through debt, it is called as leverage buyout. Okay. Any question which I have left? Debt is loan. Debt is means loan, Kuntal. Okay. One is equity, one is debt. Debt is which I need to pay, which is my obligation, which is my liability in simple terms. I, as an individual, I'll take it, give you one example to understand it. Equity is what I own, debt is what I owe. I need to pay it. This is my future obligation. I have taken a loan from you and you ask me to pay after 5 years. So after 5 years, I need to pay it. That is debt for me. Okay. Whereas for equity, I'm the owner. Nobody, I need not pay anything to anybody. But that is an obligation for me. That is liability. Okay. So I hope I have answered all the questions. There is no doubt pertaining to this PPT. Fine, then let's move ahead. M&A is merger and acquisition, Urvashi. Two companies comes together for synergy. Let's say one company is Vodafone, another is Idea. They merge together. So 1 + 1 is 11. That is the synergy which they look for, is prime objective of this merger. Now, talking about the objective of financial management, personal financial management, or what you call as managing. So what is objective? Whether it is personal, whether it is public, whether it is corporate. Objective is one or the same thing that will remain, that can be applied in all the spheres. For example, if I talk about the company, what is their objective of managing the financial, maximizing the shareholders' wealth? That is profit maximization. Growth of the organization, expansion of business, diversification. Diversification could be in form of, let's say they are operating in one particular segment and they want to go in different other segment as well. They are diversifying. For a very simple example to understand is any company is in fast moving consumer good, FMCG. They are in one particular category. So shampoo and all. They enter into another business like food category as well, which are used on a regular basis. Fine. So if they introduce one more product or the expansion, and different category can also be introduced. Another way of expansion could be the using the territory or expanding the territory. For example, they are available in one area, north. They are expanding the business in the south territory as well. Or they are available in one particular country. They are expanding to outside country as well. They are looking for their expansion in abroad. So that could also be growth perspective. That can also be regional expansion, can also be taken care of, diversification. Proper utilization of fund. This is core area or the aspect where we will discuss further as well. So objective is whatever funds are available, whether it is raised through debt, whether it is raised through different sources, how it can be effectively utilized to get maximum return out of it. And avoidance of risk as well. Maintenance of liquidity. What exactly this term means? In very simple word, the liquidity means how quickly you can convert your instrument into cash or investment into cash. In general example of the asset classes, I will classify as how you have equity into, or you have certain shares in your account, you have amount in your bank, you have gold, you have real estate. So what is highly liquid, which can be quickly converted into cash? Once it comes to real estate, let's say you have invested in some property. Now it is not highly liquid. You cannot immediately sell it. It will take time. When it comes to cash in bank, that is highly liquid. You can withdraw it easily because it is available in your saving account. So high to low liquidity wise, if I need to put these example which I have quoted, so I'll put cash and cash equivalent first. These are liquid. In saving bank, whatever cash is liquid. Then coming to another category where liquid funds are there, which can be quickly sold out and get settled within one day. Then equity T+1 settlement. You can keep that. You can sell it out. Fine. Gold if it is available for sale. Physical gold also that, but the category will be lower down. Quickly converting into how easily you can convert it into cash. That is the liquidity associated with these. Yes, Gajendra quoted. Yes, Gajendra has quoted one example of ITC, which has into food product, which has into school supplies, hospitalities. Yes, so many companies are there. You can very well think about it and quote. Now, talking about three important decisions. Anybody would like to quote the answer? What are the three important decisions in finance? Managing fund, okay. Anybody else? Maximizing profit, okay. Prachi, budgeting, strategic decision, investment decision, okay. Finance, investment, cash flow, okay. Financing, dividend. How much to spend, save, and borrow? Okay, let me read all the answers because I cannot neglect those points. Those are also having value, but basically, what I intended to ask was these three decisions, which you most of you have mentioned: investment decision, financing, and dividend. Apart from that, whatever points are mentioned that are somehow related with this, either they are subset or the part of these decisions or linked with this. So I'll not ignore them. I'll just read it. So you have written managing funds, budget estimation, maximizing profit, strategic decision, managing risk, investment decision, yes, discussion related to future growth, okay. Then managing liquidity, risk management, finance, investment, cash flows. Earn more profit means maximizing profit and minimizing cost, Tanisha, right? Financing and dividend, risk management, spending, save, and borrow. Yes, Neil, basically your points can be easily accommodated in these three. Others also, very well. Financial operating, share equity, forecasting, and budgeting. Right, somehow connected, but broadly, we will discuss these three: investment, financing, and dividend decision. Right. So first, we'll go with financing decision. What exactly we had discussed so far once we were discussing about cost of financing, like how they are going to source money. Decision means if it is debt, what will be the period of financing? That means for how long they are asking for debt. It means if it is loan, for how long that loan tenure will finish. The second thing, if it is bond, if it is 10-year, 5-year, more than 10 years, so that is duration. Raising of finance from various resources, we have discussed about equity and debt, and the decision different types of source, tenure, how much will be the cost associated with it. Usually, what happens once we talk about the equity and once we talk about debt, where the cost is higher, equity, the cost is high as compared to debt. Debt is always cheaper. Reason being, debt comes with tax shield. Fine. So cost of debt will be lower than equity because it is less risky for investors, but investors are requiring a fixed amount of return on an annual basis or in interest, what you can call coupon, you can call on regular basis. A very simple or basic example to understand this is if any business wants to raise money, so they through equity and through debt, what is going to happen in both the scenario? Scenario one is debt. If they are raising money via debt for let's say 5 years, so every years the debt holders will ask for certain fixed amount of return, whether the company is making profit or loss. They are not bothered about if the company is loss. They want at least that fixed percentage, whether 8%, 10%, that should be sure irrespective of profit and loss. So debt is this. But in case of equity, what happens? In case of equity, it is not promising any fixed return. Even if we talk about dividend also, that is not guarantees. If it is dividend, then too it is the discretion of company whether they want to pay or not. They want to retain that, they will reutilize it, they will utilize it for the investment that can be reinvested in the business and they can earn more profit. So equity is high, it means costly. Cost of equity will be high. Here, at least 12 to 13% or even more than that is the expectation of equity shareholders. Whereas debt holders are expecting less, but they want fixed return. Equity comes with risk as well. If the current market price is down, the equity holders, if they are selling, they will be getting losses. Fine. So you understood about the difference between the rate of interest, cost of financing, cost of debt will be lower, and equity financing will be high, always high. Because the expected return which investors are requesting, that is cost of equity for company, and cost of equity will be high. And that will be more than risk-free rate of return. Now talking about next step, which is investment decision, investment in fixed asset. That is capital budgeting. For an office, there are certain expenses for any organization. What they do, they incur certain expenses on fixed asset, like fixtures and all. Current assets are there, which is part of investment decisions. Working capital decisions are there. These all will be part of investment decision. Financing is what? Various sources of finance, like IPO will come in the financing decision. Investment decision, investing, where they are going to invest that amount which they have raised, this investment decisions. Now, dividend decisions, once the company has invested the amount in their business, they will be generating profit. So dividend is profit which they are generating from the business. Whether they want to share it with investors or not, if they are sharing it, that is the dividend ratio and payout ratio, and what they are retaining is a retained profit, retention ratio. So amount of retained profit, which will be finalized after paying the dividend. If they are not paying, that means they will make certain more plans, they will reinvest that amount. There could be growth and expansion plan for that business. So they'll be reutilizing. And furthermore, you can understand if they are not paying, that amount will be accumulated and that can generate more profit. Yes, Girish, you have raised hand. If there is any question, you can write in chat box. Working capital is a requirement for the short-term requirement, means day-to-day operations. That is working capital. That is, we are talking about short-term requirement, short-term working capital requirement. Means they, for operations, what they do, they need to pay rent, they need to pay the salary of worker, general debtors are there. If they purchase certain raw material, they need to pay. So these all will come at working capital to manage a business on regular basis. Okay, Rohan. See, cost of debt versus cost of equity, if we talk about Ronak this in a larger perspective, cost of debt for a company will always be less, cost of equity will be high. From the investor's perspective, debt, that will be my return. For me, it is return. For company, it is cost. For me, as an investor, it is a return. So the expected return on debt is always less. Expected return on equity is higher because it comes with risk. Higher risk, higher return. Right? Further simplifying your understanding, for me, it is like I'm getting 8% on debt. I'm getting, let's say Nifty is giving 12 to 30% return. So average return is 13%. For me, the rate of return is higher. So as the risk, market might go down, I might not get 13%. It could be negative as well for a certain period. Here, it will be fixed. So Girish, that simply means where you are going to invest the amount. Investing decision means where you are going to invest. For a company, what are the different investment obligation? Investment is they invest for the office, they invest for the rent, they invest for fixed asset, plant and machinery. Then office means for the salary of employees. If they take certain raw material, they need to pay for that. Inventory management, these all are the requirements. So where you are going to, where they are going to deploy that fund which they have raised, it is part of investment decision. Okay. So this is a brief idea about whatever we have discussed just so far, but in a different manner. Like for capital investment, decide what projects to invest in. Here, let's say there are two projects, project A and project B. Proper analysis of both the project based on the future cash flows, they will determine what is the net present value of that project. Is it feasible to go for this project or not? What is the possible risk associated with investing in that project? So risk adjusted return is required. So capital investment is always talking about what to invest along with taking care of risk as well once they are taking this capital investment decisions. Then talking about capital financing, how to fund capital investment. Optimizing firm's capital structure. Here we are talking about mix of debt and equity. How much should be the debt? How much should be the equity based on the situation, based on the required, taking care of cash outflows and inflows in a stipulated time. Right? Will they able to, if they have raised a huge amount of debt, will they able to repay it on timely basis or not? If they have sold out certain portion of equity, how it is going to impact their company, it is going to impact their capital structure. So these all things are taken care of in capital financing part. Now, dividend and return on capital employed. How and when to return the capital to investor? How and when to return? That means we are talking about the part of profit, dividends we are talking about. If the company has made profit, whether they want to pay to investors, some of the percentage, not the entire profit will be given to them. They will retain certain amount, they will pass on certain amount to investors and rest amount will be retained. So how much will be retained and how much will be paid off, whether they are not deciding to pay any dividend, entire amount will be retained and further employed to the business to earn more profit, thereby maximizing the profit. Right? Just go through this, although we have discussed about this in detail in the previous session, means previous PPT, sorry. So determination of total amount of asset to be held in that company and the composition of these assets and the business risk complexity of the firm as perceived by its investor. So how much should be invested in the fixed asset, plant and machinery, and then they need to take care of what are the future cash flow requirement. Okay. This we have just discussed in a practical manner. So I don't think there is any point which is not clear. If still anybody would like to ask anything, just let me know. Short term about the working capital, which we have just discussed. That means we are talking about requirement of day-to-day management, like how the decisions will be taken on the basis of raw material requirement, payment to these sundry debtors, working capital requirement, rent, furniture, fixtures, and all. Furniture fixtures are the one-time requirement, but in expenses which are incurred on regular basis. That too, less than 1 year period is working capital. More than that, that is long-term decision, which will be basically towards the expansion of business plan, fixing a new plant and machinery, relocation, growth and business, setting up another unit. So that will be long-term decision. See, Reshmi, capital budgeting decision, we will discuss about these through NPV and IRR calculation. Okay, that will be long-term decision. We will take certain example and explain this. Okay, now these are few areas or the points which can be considered as the example. Decision on projects to invest in. That means company will not have only one option. They will have certain opportunities available. So now how they are going to decide which is the project which is feasible for them or viable for them. Based on that, they will invest. So decision on different project based on the calculation related to cash flows, present value, the present value of which project is high. Based on that, they'll decide. Other factors are also important. Opening a new firm, that means whether for opening a new firm, how much amount is required, then how it can be benefited, what will be the future cash flows for that. So the entire forecasting is prepared, and then they invest in that firm. So opening a new firm, relocation, entering into the new market, these all we have discussed. Entering into new market means they have already a niche area, niche market. For example, they are existing in a particular location in north, and they want to enter into the south as well. So new area, new market where the segment is different, target segment is different. Earlier, they were capturing the elite segment. Now they are capturing the segment which is what you call as mediocre group, the second group. One example you can take, which is very practical in this term. For example, you know the price of shares. Earlier, they have issued at 10 rupees par value once the new fund offer was there. I'm talking about the IPO which has been listed long back, just like Reliance or NTPC or HDFC Bank. Now talking about share, you all will be aware about the Nestle India Limited. The price of that share was very high. Recently, it has split from rupees 10 face value to 1 rupees face value. Now what this decision of splitting the shares is one basic idea about the splitting share is to make it affordable to the retail investor. A share which is priced 50, let's say 50,000 rupees or 80,000 rupees will not be investable for each and everyone, which cannot be afforded by everyone. But once it is available at 2,600 rupees per share, it increases the affordability for the retail investors. Right? So that means the target segment has been increased from elite to retail category as well. Okay, acquiring another business, that is part of acquisition only, M&A part. To make our business more profit, to make our business more bigger, they acquire another. Hostile takeovers are also there. R&D of new product and services. How do they invest money? How the investment is being done? Research and development requires a lot of capital. Research and development related to new product and services, it is not immediately launched. Any of the product and services which has been offered by a company, first tested, they launch, they test, sample surveys being done. Based on the result, they make it on a larger scale. Now, next is maximizing return on capital investment. How they are going to avoid risk. I'm covering both the point together. Second is the risk minimization. Once you are minimizing risk and maximizing return, that is the core of our business strategy. By taking less risk, you are giving more return. This is the core of the profit maximization. Okay, return on capital employed should always be greater than cost of capital. Then only we can say, we can draw a conclusion that business is profitable. So how do you understand this? That means, let's say cost of capital is you have invested certain amount and you, that is 100 rupees, and you have the capital which you have invested 100 rupees and you are earning 120 rupees, that 20 rupees or 20% is your return. What if you are investing 100 rupees and you are getting 80 rupees? That means there is a loss making proposition, right? So it should be cost of return on capital employed should always be greater than cost of capital. Then only we can understand that business is profitable. Okay, any question, any doubt? Anybody who has any question? Priyansh, I'll just check with the team if they can share it. Otherwise, we need to follow the format which is always there. You can refer to the recording as well. And then what is the process till now is they share the PDF once the session is completed so that they can go through. And then if any query is there, they can raise the ticket, they can connect with the trainer as well. Immediately you have an option to write in chat box, you can ask your doubt. That's fine. Okay. No problem. In PDF, what is going to happen? It will not be in this PPT form. It will be in a bookish form, like hardly 5 to 10 page. Yes, Kartike. Recording of live classes will be available in your LMS. Some of them, some of you have already seen it. So I think it is already uploaded. Today's recording will be uploaded by tomorrow. See, return on capital, see, ROCE, return on capital employed is different. That means how much return I'm getting on my capital which I have invested. Let's say I have invested 100 rupees and I'm getting return 20%. It has become 120. So effectively, how much I got at 20% is my return on capital employed. It should always be greater. If it is less, that shows uh, that business is not in profit. Okay, 1 second. What points will be covered in next session? Next session will cover, we'll begin by time value of money, Jefferson. We'll first discuss about different factors which are affecting the investment decision. A little bit more detailed version about these financing decision, 3 important decisions, dividend decisions, these all will discuss, and then we will come to time value of money directly. Once we cover the time value of money, during that period only, if the Excel is introduced, we'll discuss about the PVFV concept, right? From the basics only, we will discuss the Excel so that you all can do simultaneously. You can open your Excel, you can start doing certain practice questions as well during the session. Yes, anybody who is having any doubt, just write, because next subtopic we'll discuss in the next session. Okay. Fine, everyone. Then that's all for today's session. We'll meet in next session, next Saturday. Fine. Thank you. Thank you, everyone. Thank you. I'm ending the session.